So what is my company worth? That is the existential question of every private company CEO. Well, the short answer is that it is complicated. For one, we're dealing with a market that's not transparent. Only a small fraction of private company transactions have a deal value attached to them, even fewer with disclosed multiples or deal structure. And no two companies are the same. Even though selling directly competing products to the same types of customers, one might have a larger, more profitable business selling on-prem licenses and maintenance, but with very little growth, while the other is a young SaaS company that isn't profitable yet, but doubling in size every year, and they could be valued very differently. Ultimately, your company is worth what an informed and motivated buyer would pay for your business, and the process that underpins that is called price discovery, which is the process that occurs in a marketplace as buyers and sellers interact to determine the price of an asset, whether it's stocks, real estate, or private tech companies. During that process, they'll be looking at financial metrics like how much of your revenue is recurring, what your margins look like, and how fast your business is growing. But they'll also be examining your intangible assets, whether it's your leadership in a given market, barriers to enter you've established, an experienced team with specific domain expertise. It could even be years of data that you've collected that would be impossible for a buyer to replicate. These are all things that acquirers can't easily build, so it becomes imperative to buy them. But at the same time, intangible assets are very difficult to value using traditional valuation methods. The main goal of using valuation methodologies is to put the deal in a ballpark range, but ultimately, it's the process that determines the outcome. In a badly run process where you're negotiating with a single buyer, it will be at the low end of the range. And in a well-run competitive process with multiple buyers at the table, the valuation will be at the high end of the range. So let's dive into some of the more well-known valuation methods. The first four, sales and earnings multiples from public companies, comparable transaction analysis, and discounted cash flow, are the most commonly used methods in tech. The others are more commonly used in acquire-hire situations or valuations of non-tech companies, so we won't be covering those today. But diving into the first four, sales multiples from public peer companies can help us gauge in real time what companies in similar industries or offering similar types of solutions are trading for in the market, and we use enterprise value and revenue as the inputs for that. Earnings multiples are important for valuing companies or offering IT services or firms that have a lot of pass-through revenue, since software companies are often reinvesting profits to drive growth. Comparable M&A transactions is about as close as we can get to an apples-to-apples comparison, because it allows us to compare multiples of private companies that are of similar revenue size and composition. However, this data is not as readily available, and discounted cash flow is an important means to capture the value of future earnings and growth, but it can vary widely depending on the discount rate and terminal value method used. It is important to acknowledge, though, that these methods are not appropriate for every kind of company, especially those who are the main assets are the team and the IP, and where there isn't necessarily a real business model, but rather a series of paid proof of concepts. These methods are appropriate for companies that have a mature business model, are growing at a steady clip, have earnings, and GAAP financials to base the valuation on. When looking at comparables for analysis, it's very important to take quality of revenue into account as well, because not all revenue is treated equally. There is a hierarchy which is roughly represented by this diagram, which has the highest multiples and gross margins at the top and lowest at the bottom. The most highly valued revenue is SaaS and subscription revenue with minimal churn because it's scalable. There's no marginal cost associated with adding extra seats. The revenue streams are recurring, which adds predictability that buyers value, and is underpinned by proprietary technology. It's important to note that not all recurring revenue models are SaaS in the pure technological sense, and depending on the industry, the recurring aspect of the revenue is more important than how the technology itself is delivered. Transactional platform revenue refers to online businesses that run platforms and make money by taking a cut of the action. This type of revenue is also very scalable because the company's only costs are running the platform itself, and there are minimal marginal costs involved. These types of businesses may or may not have recurring revenue in the sense of paying a monthly subscription, but it can definitely be reoccurring, and the bigger the platform, the more valuable it is. Managed service models, on the other hand, are recurring for a set term, say 3 to 5 years, but don't scale as easily as software. Some examples of these include cybersecurity consultancies or hosting firms. Perpetual software licenses and project-based services are one-off sources of revenue and not as highly valued, while hardware and software resellers are essentially selling a commodity, which gets the lowest valuations. So it would be remiss to talk about valuation methods without taking the buyer's perspective into account. Every buyer's thinking about the business case of acquiring your company and where they can take that business with their resources. In 2005, Google paid $50 million for Android, which barely had any revenue, but let's be generous and say they made $1 million. So paying 50x revenue sounds high, but does anyone think that they overpaid? Of course not. They're making tens of billions a year from it. It's also important to note that deals where the buyer's only interested in the customer list of a business, but not the tech or the team, without a concrete business model to go along with it, will generally see lower valuations than businesses that are immediately accretive. And of course, companies that offer valuable IP with strong barriers to entry may see high valuations that are entirely decoupled from financial metrics, like the Android example. So in order to help buyers make their business case and build their models, we need to give them good data. So before taking valuation, we need to have a set of GAAP financials ready to go. If you're using cash-based accounting, you may need to hire a fractional CFO to help you convert your financials to accrual. Revenue recognition is really important because you may think you deserve a certain multiple on $5 million in revenue. But when you recognize the revenue on an accrual basis, you realize it's actually closer to $3.5 million, and buyers will only make offers based on GAAP financials. We also see issues with gross margin accounting. Oftentimes it's neglected entirely, but just because you're not selling a physical object doesn't mean there's no cost of goods. There definitely are, and you want to make sure you capture the variable costs like credit card processing, hosting, or customer support services. And when looking at EBITDA adjustments, you want to limit add-backs to owner and other non-recurring and unusual expenses. It's also really important to get your pro forma forecast in order, since the buyer will use his to run a discounted cash flow analysis. So we want to have a solid bottom-up model that incorporates your booking and sales pipeline with quantifiable drivers of growth and documented assumptions. We will also want to have a solid grasp on the KPIs that can be used in these models, like customer acquisition cost and churn. In terms of positioning your business for maximum value, you will want to complete any transactions in your business model prior to going to market, whether you're going from a project-based consulting shop to a managed services model or a license and maintenance model to SaaS. We generally want to optimize higher quality, predictable recurring revenue, and scalable growth. And be prepared to talk about your business's unique value proposition. I'm sure most of the people listening today are used to pitching their product to customers, but talking about your business goes beyond covering your product's feature sets. We need to consider what the business is best at or are the only provider of, how your business compares to the competition, and when you beat them, why do you win? Having the cheapest price is never the best answer. Think about any unique skills or domain expertise you can highlight, and what are the barriers to entry that stop your biggest competitor from spending millions to take your market share? These are all questions we try to answer when preparing deliverables for our clients.